what's up, YouTube? You know it's your boy JB, and you rocking with me, and I'm rocking with you. And I want to welcome you back to the channel, Stocks on the Go. And if you are new to the channel, please go ahead and hit that subscribe button, guys, and the notification bell. Oh my, guys! As you can see, the market is a bloodbath, and I just want to bring a little update to my new investors. Just a surety to you guys, making sure that you guys know that this has to happen in the market. This has to occur in the market. Stocks can't just go up, guys. We have to consider that we've had a 2-year run of stocks just going completely up. If you're just getting into investing right now, then you guys are basically starting how I started back in 2020 when I started investing. And guys, I entered into a bear market, and if I knew what I knew now, then I would have came out a lot better. So let's just get into it. What is FUD? This can really destroy you as a investor. FOMO and FUD, guys, those are two key things that I want you guys to go and research, do your own due diligence on, and just get it down. So I'll just give you a quick info on what is FUD. FUD, investment strategies based on FUD are not usually recommended. Sometimes FUD might be justified, but in general, the term is used to describe unwarranted negative sentiment in the market. FUD can be thought of as the opposite of FOMO, fear of missing out. And that's the same thing I was just telling you guys. You got to understand what these two things mean. Okay, guys? While FOMO tends to affect people on a more personal level in that they don't want to miss out on potential gains, FUD can be described as a more collective effect which spreads like wildfire, typically through social media. And as you can see, guys, if you go on YouTube, you type in stocks, every YouTuber will be telling you that the stock market is crashing. You're hearing it on the news. Stocks are going down. But guys, this is not financial advice by any means. This is just my insight and my look at things. And I really do think that this is a buying opportunity, guys. It's like you've been looking to get that PlayStation 5 all year, and December comes and it's Black Friday and they're giving you a sale price, and you won't question it. You're going to go in and you're going to go and buy that PlayStation 5 because you're getting it at a discounted price. And as I showed you guys at the start of the video, those stocks are some of the top tech stocks, and they're all down. I'm talking about 25% down, like 11% down. Guys, these are buying opportunities. And as I said, if I knew what I knew back in 2020, I would have invested through that down period. And right now, guys, the gains that I would have accumulated would have just been ridiculous. So the stock market can sometimes scare new investors. And I just wanted to give you guys that assurity that, guys, this won't last forever. This is just a period. And I'm going to jump into a video right after that's just going to explain that this is something that has been happening for years in the stock market. So if you're a new investor, guys, yes, the stocks are going down, and I'd advise you to not just jump in, but dollar cost your way in. Dollar cost average your way into these big tech stocks and look at it as a discounted price. A lot of these stocks you will never see at these prices again. This is absolutely the greatest transfer of wealth, guys. So I'm going to jump into the video, and you guys can watch it to the end, and you can leave your comments in the comment section if you like what you're hearing, or if you have any input. As you know, we chop it up in the comment section all the while. And yeah, guys, so I'm going to jump right into the video. All right, here we go.
Let's talk much more about the latest market action and expectations for this week's Fed meeting with our next guest. Michael Lee from Michael Lee Strategy joins us now. And we thank you so much for your time this afternoon. Taking a look at the price action that we're seeing in stocks today, of course, this is just extending the volatility that we've seen over the past couple of weeks so far. Is this, in your opinion, all about the Fed and expectations for tighter financial conditions? Or what do you think is driving the selling that we're seeing?
Emily, I think you hit the nail on the head there. I think this has everything to do with the Fed and the fact that as of right now, there's simply no consensus as to what the Fed is going to do. Inflation numbers keep coming in hotter. Some economic numbers are coming in hotter. Some are coming in cooler. And as a result, you just have a wide range of opinions, wide view of where interest rates are going and what the Fed is going to do. I don't think anybody is sure what the Fed is going to do, including the Federal Reserve themselves. I think this year you could see very different thoughts on the dot plot, very different sentiments in the meeting minutes as we go from month to month, from meeting to meeting, because this is very much a fluid situation. And there's nothing that the market really hates more than that sort of uncertainty. The entire risk asset class universe is priced in one way or another off the U.S. Treasury curve. And so as that Treasury curve is in somewhat of a flux, and there's such a wide range of viewpoints as to which way it's going to go looking forward, it becomes very difficult to price anything. And as a result, a lot of risk capital just walks away from the market.
So, Michael, you mentioned that there is no consensus in the market and perhaps even in the Fed itself over the next move here. What information, economic data, market data do you think would inform the Fed and market participants about what that next move might be?
Well, look, I think the Fed's between a huge rock and a hard place here. I think the accelerated bond buying, the size of QE, doesn't necessarily help the economy, but it stabilizes capital markets. And the full force that came with it a little less than 2 years ago absolutely stabilized capital markets, and then the economy took off. And in my opinion, maybe a year ago or a little over a year ago, they should have slowly but surely reduced that level of bond buying to where it's at a manageable number. So you start with this taper and what has become an accelerated taper from the initial thought to now rate liftoff instead of maybe coming in September, as some were predicting last fall. It's looking more likely it's going to come in March. And you have smart people out there saying that 50 basis points in March is a realistic number. So I think will
Michael,
yep.
I got to interrupt you on two things there. Because you've
Sure.
pointed out that when you everyone take a step back and take a deep breath, because you've pointed out not a lot has changed in the last year. When you look at this market versus where we were 52 weeks ago, still up 12% on the S&P 500. But when you talk about the Fed, we hit highs on the S&P 500. You had to have your head under a rock and underwater to not know interest rates were going to start going up in March. So what changed all of a sudden?
Adam, exactly. So that's my sentiment, is that over the last 3 to 4 weeks specifically, we went from the consensus being, okay, accelerated taper to 3 rate hikes to, well, you know what, maybe it's not going to be 3 rate hikes. Maybe it's going to be 6 rate hikes. Maybe it's going to be 5 rate hikes. And then you have this varying opinions out there. And then you have people like Larry Lindsey the other day saying, maybe they'll raise twice, but then abandon ship. So you just have this wide disparaging viewpoints of where the Fed is going to go. And what I think has happened is a heightened level of uncertainty as to which way the Fed is going to go. I don't think there's been any fundamental change in the economy over the last 3 or 4 weeks since we started this accelerated sell-off. We've had some good news, we've had some bad news, but nothing to say, okay, well, the market should all of a sudden, in the blink of an eye, be worth 10% less. So I think we're in a little bit of no man's land. I mean, to me, this is reminiscent of what you saw a lot in 2018, albeit it's happened a little bit faster. You also saw some sell-offs like this, again, not to this degree in 2016, 2015, 2014, 2013, 2011, and 2010, all based around what the Fed is going to do. When there's this level of uncertainty, you get a heightened level of volatility and somewhat directionless in stocks. And I'd say, earlier this afternoon, we looked on our way back to much smaller losses than the news about, 8,500 troops being authorized or being heightened alert for deployment kind of derailed that. And here we are fighting back. I wouldn't be surprised. Maybe we don't get back to those all-time highs. If we recover a lot of these losses, only to see sell-offs like this a few more times before we come to some sort of consensus. I'd say these next few Fed meetings are going to be some of the most significant in the history of the United States Federal Reserve.
Michael, what areas of the market sectors or names specifically do you think are best positioned to rally back, as you mentioned, see some of this recovery after the sell-off that we've had the past couple of weeks?
Yeah, so as Jared was mentioning, the healthcare sector has really been unloved. I would be, is the sentiment there too negative for it to rally back? I think, I don't know. That's something I own. I'll continue to own. Energy, you've now, in my opinion, gotten an opportunity to step back into a sector that's red hot and doesn't look like it's going to get derailed anytime soon. I like XLRE and utilities as well. But look, we'll see where the market's going. I don't know how you can not own tech. It's a matter of, are you dramatically underweight or are you equal weight in the XLK as you have it up there? We've seen some unique events happen over the last couple of weeks. Microsoft making not only its largest cash acquisition ever, the largest cash acquisition ever. If the boardroom at Microsoft thought their stock was overvalued or fair valued, why would they pay for this deal with Activision in cash? So in my mind, that's a pretty bullish sentiment. Then that's acquiring company making that big of an acquisition, that's that big of a major player in all the major indexes is going to weigh in the market. Combine that with Netflix, and all of a sudden you have an avalanche. And to understand these sorts of sell-offs, you need to realize that you have momentum players that are going to push markets in both directions. However, when you go to the downside, it gets much, much more uglier versus when you get momentum to the upside. Now, why is that? It's because people panic on the way down, and no one panics when they make more money. So what I think you're seeing right now is a lot of confusion going on, and I think this confusion remains with some rallies and some ugly sell-offs until we can get a fairly tight consensus of the Fed, whether it's 4 or 5 rate hikes or it's 3 or 4 rate hikes or something more narrow than people saying we're going to get 50 basis points in just 6 weeks versus no rate hikes at all. I think the range of viewpoints is too wide. It's too hard for large players to commit large amounts of capital, if that makes sense.
All right, we'll leave it there for now. Michael Lee of Michael Lee Strategy, thank you so much for coming on this afternoon.
Thank you.
Hey guys, so we are back, and I know this video is a little bit longer than my other videos, so I'm going to try and cut it as short as possible. But as you can see, this is something that happens historically, guys. It's been happening from as far as we can remember in the stock market. So don't get scared, don't get discouraged, guys. Dollar cost average into your plays and wait for the outcome, guys. That is it. Look long term, invest for long term stocks right now. Right now, it's not the time to be trading, it's the time to be investing. All right, guys, you can check out the links in the description. Easy way to make some quick cash, and you can go ahead, like, subscribe, hit the notification bell. Thanks for chopping it up with your boy JB, and yeah, it's your boy Stocks on the Go. Let's go.